12 years ago, I thought investing was only for rich people. I kept everything in a savings account, earning just 0.01%, and it cost me thousands of dollars in missed opportunities. Then I realized I needed to change something and started a simple investment strategy in 2014. What was the result? After investing just $500 every month as a beginner investor, my actual portfolio grew to over $500,000. And today I own 22 rental properties worth $5 million, and I have a $1 million stock portfolio because I invested wisely in the last 12 years. So in this video, I'm breaking down exactly how I did it. Today, you will see my exact investment split that turned $500 per month into $500,000. The platforms I used to invest properly, and also the beginner mistake that cost me $400. And more importantly, how to get started with just $50 if you don't have $500 to invest right now. Let's get started. But first, why is investing just $500 so powerful? $500 isn't a magic. It's around 10% of your take-home pay for median income in the USA. Big enough to matter, small enough to maintain your current lifestyle. Here's the power of $500 per month at an 8% return, which is the typical returns of the S&P 500, but more on that later. If you just keep doing that for a year, you will have $6,100. After 5 years, $36,000, 10 years, $91,000, 20 years, $294,000. Just think about it. After 20 years, you have almost close to $300,000 from slow, boring consistency. Most of that growth isn't your money. The compound interests are doing the heavy lifting. But what happens if you invest for 30 years, not just 20? That would be $745,000. You might ask, when would I become a millionaire? It's actually in 34 years. So what happens if you invest more like $1,000 per month? You would become a millionaire in just 25 years and 6 months. You might also ask, why can't I invest $1,000 one month and $200 the next month? Why should it be exactly $500 every month? So let me tell you about dollar cost averaging. It means the dollar cost averaging to work, you will need to invest the same amount in each month. Then you can get the cost basis spread over the investment duration. What that means, when the stock market is high, you are buying less shares of the index fund and vice versa. Start early, start small, but you should start. Before going to section 2, if you are interested in learning more about finding great investment opportunities while working full-time, click the link in the description to join our entrepreneurship mastermind program. Anyway, $500 a month gets you to nearly $300,000 over 20 years. But where do you actually invest it? Because if you allocate it wrong, you are leaving hundreds of thousands of dollars on the table. So let's talk about my exact $500 allocation, what I did for last 12 years. First $50 I put into individual stocks. That's just 10% of $500. This is my learning money. I buy small positions in companies I understand. For me, that was Microsoft, Tesla, and Nvidia in the last decade. Beginners should keep these under 10 to 15% max of their monthly investment. Then you only lose a fraction of your actual investment even if you are wrong, and it's a learning opportunity for you. I bought Microsoft stock when I started working for Microsoft in 2015. I bought Tesla stock when I got a chance to demo drive a Tesla Model 3, and I was completely blown away with their vehicle capabilities. Those simple, small amounts of learning money investment grew to 10x over the 5 to 6 years. My next bracket, $150, I put into Roth IRA. The main advantage of a Roth IRA is you can grow your wealth tax-free and withdraw tax-free after your retirement. If it becomes $200,000 one day, you keep all of it. Typically, I buy long-term reliable company stocks like Costco, Walmart, Berkshire Hathaway with the money. But you will need to do your own research before buying any individual stocks. Let's talk about the larger portion, 60% of your money, $300. I always put into index fund. Typically, I put into broad index funds like VTI or SPY or VOO. This gives you pieces of thousands of companies. The advantage of index funds is fees are extremely low. and you don't have to guess which company will win, which means this is one of the lowest risk investment you can make. But check the expense ratio and liquidity of the index fund or ETF before investing. So you have got the split $300, $150 and $50. But the platform you use to execute this determines your fees, your access, and whether you can even buy fractional shares. And when I started, I almost picked the wrong one. So in this section, I will talk about what platform I use. So here's the simplest advice you need to get started. My main brokerage is Fidelity, which offers zero commissions, easy app, fractional shares. It's where I invest most of my money. I use Vanguard for Roth IRA. It has the lowest fees and great long-term place for retirement investing. The Vanguard S&P 500 ETF VU has an extremely low expense ratio of 0.03% compared to its other ETFs. It also offers $0 transaction fee to more than 160 Vanguard mutual funds and over 3,000 funds from other companies. You might ask, what are the alternatives? If you are a beginner investor, you can also start with Robinhood, which is very simple and very user-friendly for beginner investors. The only disadvantage is you won't get the best market rate for the transactions, since Robinhood sells your order to other brokerages. For my other transactions, I typically use Interactive Brokers, which is more for experienced traders and investors. It gives me best market rate in the transaction, but there is some learning curve on starting the platform. But you will learn in no time. One thing I can say, the best platform is the one you will stick with, because you will keep learning about the platform. You need to use it for the long term. Now, if you got the allocation and the platform, we're already ahead of most people. But none of this matters if you make the mistake I made in my first 90 days and it cost me $400 I am never getting back. So let's talk about my $400 mistake. In my first 3 months, I chased hype stocks I saw on social media, meme stock, biotech, and SPAC. Everyone was posting about how they would explode, and I got caught up in the excitement, thinking that I was ahead of the curve. But as you might expect, things didn't go as I hoped. All 3 stocks plummeted. I panicked and closed the position, locked in my losses out of fear of losing more. But looking back on it, if I had just put that same money into SPY and done nothing, I would be up today instead of down. So if you are a beginner investor looking to build wealth safely, avoid any of the following. Number 1, chasing trends, because you won't know when trends will reverse and you will lose money. Avoid panic selling. Everyone is selling, you won't make money in the stock market. Number 3, avoid trying to time the market, because even Warren Buffett, who is one of the world's best investors, doesn't even know how to time the market. Next one, investing money you will need soon, because the stock market can be irrational for a long period of time. So my advice, only invest money you won't need for the next 5 years, so that your invested capital at least get a chance to return reasonable return. Now let's talk about how to start with any amount. I know what some of you are thinking, $500 a month is a lot of money when you are just starting out. But the good news is you can start with way less. Here's how. If $500 feels big, start smaller. Follow the exact 4-step process to start investing. Step 1, open a free brokerage account, Fidelity or Vanguard. It just takes 15 minutes. If you need help, comment below. Step 2, automate your contribution. Even $50 per month builds a habit. Step 3, buy one index fund. Search VTI, SPY or VU. Invest whatever amount you can. Step 4, increase slowly. As you get raises or pay off debt, bump your contribution by $25 or even $50. Consistency beats everything. Alright, you have got the allocation, the platform, and you have started investing, even if you don't have much to set aside. But here's the question I get more than any other, and it's the one that stops most people from ever making profit in the first place. And the question is, what if the market crashes? Imagine you have been investing $500 a month for 6 months. Now you check your account on a typical Monday morning, it's down $1,200 from where it was on Friday. Your stomach drops. You think, I should have kept this in savings. Now I have lost money I could have otherwise had. And that feeling of remorse is quite exactly why most people quit. But think about it. If your timeline is 5 years or longer, that small crash is the best thing that could have happened to you. Why? Let me explain why. I began investing in late 2014. The market dipped, even crashed multiple times over the years. In 2018, 2020, it was a big crash during pandemic, and also 2022. My balance looked terrible each time, but I kept going, investing the same amount each time for this account. Those shares which I bought during the downturn are multifold now. If you bought anything in that time, you know what I'm saying. So, on a long enough timeline, drops are just discounts. A crash means shares are on sale because you are buying more shares of the same $500 per month. That's what happened to me as well during pandemic 2020. When the market recovers, which historically it always has, those extra shares grow faster. And that's the beauty of dollar cost averaging. If you want even more cash to invest every month, not just $500, but $1,000, $2,000 or more, I teach how to build multiple income streams inside my mastermind. The link in the description below. And if you are curious about how I managed to build a $5 million portfolio of 22 rental properties from zero, check out this video next where I break down my entire real estate strategy. See you in the next video.